I'm calling to order this hearing. This is a public hearing of the Committee of the Whole of the Council of the District of Columbia. I'm Phil Mendelson, Chair of the Committee of the Whole and Chair of the Council. Today is Thursday, February 6, 2025. The time is 2:17 in the afternoon, and this hearing is being held in room 500, the council chambers of the Johnny Wilson Building. The subject of this hearing is the fiscal year 2024 Annual Comprehensive Financial Report that came out last Friday. I believe it was Friday, January 31st. And the purpose of this public hearing is to receive testimony from government witnesses, namely the executive, the chief financial officer, and the inspector general, regarding the results of the fiscal year 2024 Acfr Annual Comprehensive Financial Report. By law, the Acfr must be submitted to the council by February 1st, 2025. This document and this hearing are important to understanding the financial health of the district government. Copies of the Acfr can be obtained after it is released from the Office of the Chief Financial Officer or on the OCFO, that's the Office of the Chief Financial Officer website. This hearing is part of a series of hearings being held this winter and spring by the council and its committees in connection with its oversight of the fiscal years 2024 and 2025 agency performance. The full schedule of these performance oversight hearings for all the committees is available on the council's website, which is www.dccouncil.gov. And the schedule is published in the DC Register as well. Members of the public were not included in today's Acfr hearing, never have been, but members of the public, of course, may register to testify at any of the council committee's oversight hearings. With regard to today's hearing, while the testimony is limited from specified government witnesses, which I should say also includes McConnell Jones, the auditors, the members of the public are welcome to submit comments for the record. The record will be open for 2 weeks. That is, it will close at 5 p.m. on Thursday, February 20th, 2025. As I said, today's hearing is a yearly affair at which the council is officially briefed on the results of the district's annual comprehensive financial report. I would like to start by commending Inspector General Daniel Lucas, Chief Financial Officer Glenn Lee, City Administrator Kevin Donahue, and their teams for another clean audit with no material weaknesses. This is the 28th year that the district has received an unqualified audit opinion. The annual comprehensive financial report, or Acfr, shows that in fiscal year 2024, the district, or at the end of fiscal year 2024, the district's general fund local sources were $12.6 billion, and its uses were $11.7 billion. Sources exceeded uses by about $904 million, but after setting aside $652 million that was reserved for subsequent years' expenditures and making other adjustments, the fiscal year 2024 surplus was $253.2 million. Our surplus must first be used to replenish our federally and locally mandated reserves, and the fiscal year 2024 surplus was not sufficient to fill these reserves. As a result, there are no additional funds to set aside for the Housing Production Trust Fund or for capital projects or to redirect to new programs. And I would further like to note the reserves, the four reserves total about 52 days worth of operating expenses. Our goal is now about 66 days, as I recall. That's because of changes that we adopted with regard to the, okay. I might share that in a second. At any rate, the reserves are total about 52 days, which is short of what our goal is, but it's the same as what it was at the end of the last fiscal year. The Acfr also shows that the district continues to have a general fund balance of $4.9 billion. As I would like to remind everyone, this balance is not available for spending, but is set aside for specific purposes. So the $4.9 billion general fund balance is roughly $2.3 billion committed to future budgets. $1.6 billion is held in our federally and locally mandated reserves. $531 million is set aside for non-lapsing special funds like the Stormwater Permit Review Fund, the Litigation Support Fund, and the Charter School Credit Enhancement Fund. And another $523 million is held in bond escrow accounts that support our $14.9 billion in debt. I should clarify that when I said 60 days is our goal for the our reserves, our goal has been 60 days, but beginning with, I think it's this fiscal year that we're in, we've actually increased that because we've increased the cash flow reserve requirement or goal or ceiling or whatever it is. So that's why I said 66 days. In closing, I want to thank our Chief Financial Officer, Glenn Lee, Deputy Chief Financial Officer and Controller, Kimberly Williams, Inspector General Daniel Lucas, all of their staffs, and our auditors, McConnell and Jones, for their work on the Acfr. And I think McConnell and Jones this is their last year with us, since best practices that after, I think it's 5 years, government should change their auditors. Following statements by the Inspector General, who's responsible for the audit, and the Chief Financial Officer, who is responsible for managing the finances that are being audited, and the City Administrator, who's responsible for administering the budget and spending all of the finances that are the subject of the audit. There will be at least one 10-minute round each for council members to ask questions. With that, I'm going to turn to colleagues. First recognize Councilmember McDuffie, if you have an opening statement.
I do. Thank you, Chairman, and good afternoon to my colleagues and to all the witnesses. I want to welcome Inspector General Lucas, Mr. Kozlik, CFO Lee, City Administrator Donahue, and Budget Director Reed. Good to see you all again and all your team who are present in the chambers today. The 28th consecutive clean audit of the district's finances is, as always, a testament to our strong financial management and accounting practices. This helps us preserve our strong bond rating and gives us the necessary flexibility as we move into likely slightly more challenging budget season and what may be a season of unpredictability with the current federal administration. The district's population growth rate leads the nation. Sales taxes grew 3.6%, primarily due to the continued recovery of our hospitality sector. Our real property tax revenue grew by 2.2%, and our office lease volume seems to be back on the rise, which is good news. Our economic future continues to be bright, at least as I view it, as an optimist, as we retain the future sales tax revenue that Capital One Arena will generate. And we now have control over the 175-acre site around RFK Stadium, which will provide us with a multitude of uses to grow our economic base. So there's a lot of exciting things that are happening in the numbers, and I know you all will get down to that when you all provide your testimony. However, the district still has some work to do. I think we could agree we will need to fully fund our federally and locally mandated reserves soon. Last fiscal year, reserves covered only 51 days, and while we increased that by 1 day in fiscal year 2024, will require significant investment to increase the reserves to the recommended level of 66 days of working capital. Although we saw modest revenue growth in fiscal year 2024, the district continues to struggle with housing affordability, education gaps amongst our most vulnerable youth, and disparate life expectancy rates by race, where a Black child birth is expected to live nearly 20 years less than a white child at birth. These realities will need to be directly addressed as we take up our next budget and financial plan. Finally, I know myself and my colleagues are committed to looking at the district spending to see where we can find some efficiencies to put those dollars towards solving some of our deepest challenges. With that, I look forward to hearing from you all today about our fiscal year 2024 finances as we prepare for the upcoming fiscal year 2026 budget and financial plan. The district's financial sustainability is the bedrock of our efforts to build shared and inclusive prosperity for all of our residents in all 8 wards across the District of Columbia. And so I want to thank you, Mr. Chairman, Again, thank my colleagues for all their hard work and look forward to hearing from the witnesses. And thank you for being here today.
Thank you, Councilmember McDuffie. Councilmember Robert White.
Thank you, Chairman. I want to thank CFO Lee and your team, Inspector General Lucas and your team, City Administrator Donahue and your team, and Chuck Kozlik with McConnell Jones for being here, and for the Mayor's Budget Director. Just to highlight a couple things that stood out for me. There are, we're seeing really uneven recovery, and we have to be aware of that. With respect to growth in leisure and hospitality, we are at about 95% of where we were pre-pandemic. That is good, but not great. We saw an increase in our population, rising above the 700,000 resident mark to $702,000 based on data from the U.S. Census Bureau. That is a good thing. We're moving in the right direction. Tax revenues are generally up. There are some concerning indicators, particularly wage inequality and the challenges facing middle and low income earners, despite continued economic recovery. And unemployment has ticked up a bit, and rates are worse in Ward 7 and 8, as they tend to be. Our citywide unemployment rate was 5.7% in September of 24 compared to 4.9% in September of 23. And we've been unable to fully fill our reserve to the 60 days of operation. This information is good to have because we have to be knowledgeable, thoughtful, and responsible about where we are and where we're going. And some emerging risks that give me some concern, but also offer, I believe, opportunities. Not so much opportunity with the first one, but the possible federal workforce reductions. And looking at the data, 17.2% of district residents work for the federal government, and federal jobs were down 0.9% in September 23. They were also down the year before in 22. And we all know what's happening right now with efforts to reduce the size of the federal workforce. And I want us to also recognize that those are people with families and homes and bills. And so we need to make sure we see even beyond the data to understand that these are people who are really affected by what's happening coming from the federal government. Office vacancies, not a surprise to any of us. In December of 24, vacancy rates for Class A buildings was 18.7%, up from 16.9% a year ago. For Class B buildings, 16.7%. Now, if we hold it in our minds, and we also recognize that there is a sharp decline in housing permits in FY24, 1,190 housing unit building permits were issued, which is a 77% decrease over the prior 12-month period. And we understand that we have increasing expenses and flattening revenues, with expenses increasing just under 50% in FY24. We have to make sure we are thinking about and looking for opportunities. And I think that there are opportunities downtown, particularly with respect to housing, possibly with the disposition of federal buildings. And so when we think about the future of downtown, very much think housing, but also recognize that housing needs other things to support it. And so there are opportunities for adaptive reuse and for rethinking what our downtown and our commercial office supply looks like. We have to think critically about how efficient and effective our investments are. It is really important for us as a city to get a handle on that, to make sure programs and agencies are working as intended, and that we are as efficient and effective as a government as possible. And we have to think beyond government, bringing government, business, and communities together to address our challenges like employment, like housing. And so in addition to building more housing, I think we really have to be thinking strongly about trade and vocational opportunities for residents, recognizing that the district, unlike most other cities, we just don't have a very big middle class. And the workforce landscape is changing. But the jobs people do with their hands, there's still demand for that. And I think there are not enough DC residents working on a lot of these projects because we have more to do to build out the pipeline. So all that to say, a lot of really good, helpful information here. It's important that we digest it, that we be very sober about where we are, but we also think critically and sometimes think outside the box in terms of where we're going and how we stabilize and right-size our economy for the best of our population in our city. So thank you again to all of our witnesses, and Chairman, thank you for convening this hearing.
Thank you, Councilmember White. Councilmember Fruman?
Thank you, Chairman Mendelson. Thank you very much to the teams that have put all of this information together. The city faces a lot of different challenges. It is heartening to see that we ended FY24 with a clean audit and no comments on it. It's also good to see that we were in a relatively strong financial position. FY24 ended on September 30th, 2024, and November brought us lots of changes. And so we are in a world with an awful lot of uncertainty. I am going to be curious to hear the testimony and to hear how you're thinking about what's going to happen going forward off of this base that we're seeing here in the Acfr. You make the comment that this informs our FY26 budget considerations. It sure does. And there will be some questions about looking backwards, but also very curious about looking forwards in this context. One of the things on the fund balance, and just to preview, in the FY25 budget process, we did some things to try to commit funds to replenish fund balances. I'm curious how those things interplay with the deficits in the fund balances that we see here. Are there things that we've done that will naturally fill the fund balances, or are we going to be called upon again to do more significant additional things? But with that, I think I'll stop and look forward to hearing your testimony and the question and answers going back.
Thank you, Councilmember Fruman. Councilmember Parker?
Thank you, Mr. Chairman. I want to congratulate CFO Glenn Lee and all who ensured the district achieved yet another consecutive clean audit. 28 consecutive clean audits for the district highlights our financial strength and how our jurisdiction far outpaces many others. In the annual comprehensive financial report, we see many strengths and some threats. The district enjoyed increases in income, real property, and sales taxes, among other areas. Meanwhile, there are widening gaps between the haves and the have-nots. Our reserves need attention and development has slowed. DC faces a lot of potential impacts from decisions made by Congress and the president. And so today, my questions will seek to better understand potential threats before us to the district's financial standing and to uncover trends baked within the Acfr. In summary, and I'll be brief here, while the district is actively investing in the future through strategic planning and addressing our capital needs while also collaborating with new federal partners, we must also confront the widening wealth gap and disparate investments across our 8 wards to ensure comprehensive economic well-being. And so all that to say, while we weather the storm currently, I will be looking at how are we ensuring we're investing in wards 5, 7, and 8 equitably. Thank you, Mr. Chairman.
Thank you, Councilmember Parker. Councilmember Henderson?
Thank you, Mr. Chairman, and good afternoon, everyone. It's always good to feel different than we felt a year ago and it not be feeling worse. So congratulations to the team on a 28th consecutive audit, which I know, clean audit rather, which I know is not a easy lift by any means. I'm going to keep it super brief. Some of my questions will focus around some of our revenue funds, as well as capital and debt service, which I had some questions on based on the report, but I look forward to your full presentation and the conversation thereafter. Thank you.
Thank you, Councilmember. Councilmember Felder?
Good afternoon, Inspector General, auditing partners, the CFO, the city administrator, and the budget director. I echo the sentiments of my colleagues. I appreciate all the work that has gone into producing this report. We know that over the last year, we've seen a lot of setbacks as well as a lot of wins. As any challenge that all cities face, specifically here in the district, we know with every challenge creates an opportunity. And we have the unique opportunity to think differently, look at the city as it is from a fiscal standpoint, and talk about what we want to be in the next 5 to 10 years. So I look forward to today's conversation, hearing what your perspectives are, which will help us as a body think a little bit more strategically as we go into the budget cycle. So thank you.
Thank you, Councilmember Felder. Councilmember Pinto? I'm told she dropped off. Councilmember Nadeau?
Thank you, Chairman. Congratulations, everybody. I'm not going to make an opening statement. I look forward to getting on with the presentation. Thank you.
Councilmember Bonds?
Thank you, Chairman, and I just want to thank you all for assembling before us today to talk about this important document. I always look at it as the blueprint, which will help us and guide us into the future. And one of the things that stands out more than anything is the fact that we are increasing our population. And at the same time, we are showing an increase in unemployment. So when I look at those numbers together, I have to assume that that coupled with the fact that the income has gone up, we must be increasing employment for those who are in the tech and professional field. So I am very concerned about what happens to those that we are not able to accommodate in today's economy, and trying to figure out where can we go with the numbers that are before us. But all in all, it's a great opportunity to hear from you. I don't know how deep you want to go into any of these socio-economic demographics that you have presented to us, but I'm all ears, and really I'm very excited that, again, 28th consecutive. This is a very great opportunity for the District of Columbia to move forward. And I hope all are listening and understanding the value of what has been accomplished this year, how we have some savings, and hopefully we can move forward with more savings into the future, because I feel that they are necessary in order to have the kind of society that we say we subscribe to. So I'm looking forward to hearing more from you today. Thank you so very much. Oh, and a special shout out to Mr. Lucas, because Mr. Lucas is in my committee, and we have had the pleasure of being a part of all of his meetings to get to this point. So we're aware of some of the information that you're sharing. So thank you very much.
Thank you, Councilmember Bonds. I think that's going to conclude the statements from council members. I do want to note the council is right now going through its performance oversight hearings. That schedule, as I indicated earlier, is available on the council's website and was published in the register. We're to get the mayor's proposed budget for the next fiscal year on April 2nd. We will have a briefing in this room of the briefing of the committee of the whole by the executive with regard to the mayor's proposed budget. Our first reading on the budget is May 28th. And final reading will be June 11th. With that, Mr. Lucas, are you the first up?
I am, Chairman.
We are on the edge of our seats, breathless, awaiting you.
As always. Good afternoon, Chairman Mendelson and members of the Committee of the Whole. I am Daniel W. Lucas, Inspector General for the District of Columbia. I am pleased to appear at today's hearing to discuss the district's fiscal year 24 annual comprehensive financial report audit results. Joining me are staff from my office of the Inspector General and Mr. Chuck Kozlik, audit partner from McConnell Jones. contracted by the OIG to independently audit the district's financial statements. The OIG is responsible for entering into a contract with an independent auditor to audit the district's financial statements annually. Following contract award, OIG staff performed day-to-day administration and oversight of the Acfr audit contract. The FY24 Acfr audit process began in May of 2024 and continued through OIG's release of the FY24 Acfr audit opinion and associated reports on January 31st. As reported, the district's overall FY24 Acfr audit received an unmodified or clean audit opinion. McConnell-Jones also issued 10 unmodified or clean audit opinions for 10 organizational units, funds, and programs. Additionally, 7 third-party audits, which were reviewed by McConnell-Jones, received unmodified or clean audit opinions. In addition to the financial statement audit opinions, government auditing standards requires McConnell-Jones to communicate to those charged with governance and management any deficiencies in internal control identified during the audit of the district's financial statements. For FY24, McConnell-Jones identified 12 control deficiency findings at district-wide Acfr level and 5 control deficiency findings at the organizational unit, fund, and program level. These control deficiencies have been communicated in 5 management recommendation reports issued by the OIG. Mr. Kozlik will be able to discuss these FY24 Acfr audit findings in greater detail during his presentation. A list of all FY24 Acfr audit reports released by the OIG are included as an attachment to my testimony and are available on the OIG's website. In conclusion, fiscal year 2024 represents the 5th and final year the OIG has contracted with McConnell-Jones to audit the district's financial statements. Within the next few weeks, the OIG will transmit through the executive the next Acfr audit contract for council consideration. We have structured this award so that there is a smooth transition between McConnell-Jones and the next Acfr independent auditors. I wish to extend my appreciation to all district agencies and professionals, as well as McConnell-Jones, who have played a role in ensuring an on-time Acfr audit. With that, I will turn it over to Mr. Kozlik to provide an overview of the FY24 Acfr audit results.
All right, good afternoon. My name is Chuck Kozlik. I'm the lead engagement partner and a member of the McConnell-Jones fully integrated audit team that conducted the independent audit of the District of Columbia's annual comprehensive financial report, or Acfr, for the year ended September 30th, 2024. Also here with me today in the gallery is Mark Schwartz, who worked with us on the audit and is partner in charge of our Washington, D.C. office. Our firm, McConnell-Jones, is the independent auditor of record for the Acfr for the year ended September 30th, 2024. And we would like to thank the chair and council members for allowing our team the opportunity to present our audit results today. I'm pleased to report that we have issued an unmodified or clean opinion on the district's financial statements included in the 2024 Acfr. Unmodified opinions were also issued resulting from the audits of 10 McConnell-Jones audited organizational units, funds, and programs of the district. We also note that the financial statements of an additional 7 organizational units, funds, and programs of the district were audited by third-party audit firms and received unmodified opinions on their financial statements as well. During our audits, we identified no material weaknesses and no significant deficiencies in internal control. We did identify 12 control deficiencies not rising to the level of a significant deficiency, which were reported in the district's management letter. 5 control deficiencies were identified and included in 4 standalone management letters. Those were for UDC, the UMC Not-for-Profit Hospital, the Unemployment Compensation Fund, and the Other Post-Employment Benefits Fund. During our audits, we identified no instances of fraud, discovered no instances of material noncompliance with laws and regulations. We had no past audit adjustments that we considered to be material to the financials, and we received the full cooperation of management throughout our engagement. This slide identifies the 10 McConnell-Jones audited organizational units, funds, and programs. Each of these entities received a standalone audit of their respective financials and an unmodified opinion. This next slide shows the 7 organizational units, funds, and programs which are audited by third-party audit firms. They were hired by management or the board of each respective entity. And as part of our procedures under the Acfr audit, we provided group audit instructions and expectations. We met with these auditors and reviewed their work and their conclusions reached, noting that each received an unmodified opinion on their financial statements. Slides 5 and 6 of my presentation provide detail behind the findings identified during our audits. As I said before, there were 12 control deficiencies identified and included in the district's management letter. Generally speaking, you could group these into issues in the areas of procurement, purchase cards, some instances of noncompliance with the Quick Payment Act, and an HR-related exception that was identified. Slide 7 shows the 5 control deficiencies identified in our standalone audits of DC organizational units, funds, and programs. These findings were included in a management letter to each of the respective entities. Slide 8 provides an illustration of the progress made by the district year over year in remediating prior year findings and implementing our recommendations. You can see here that 21 findings were identified in the fiscal year 2023 engagement, and 17 of those were remediated or fully implemented by the end of the district's fiscal year 2024. 4 of those 21 prior year findings were not fully implemented. Those 4 findings are shown here on slides 9 and 10, and this provides some detail behind the 4 findings that were not fully implemented. You can see that management was still in the process of implementing our recommendations as of 9/30/2024. There were 2 prior year recommendations at the Office of the Chief Technology Officer that were not fully implemented, one at the Office of the State Superintendent of Education pertaining to compliance with the Quick Payment Act, and one at the Office of Contracting and Procurement related to preparation, review, and maintenance of the determination and findings form that are maintained in procurement files. Each of these 4 improvements are expected to be implemented in the district's fiscal year 2025. Slide 11 begins our required communications. It was our responsibility to audit the district's Acfr in accordance with generally accepted auditing standards and to provide reasonable, not absolute, assurance that the financial statements are free of material misstatement. It is management's responsibility to select and implement the appropriate accounting policies, and it's our responsibility as auditors to review management's application of the significant accounting policies, and we have determined that these policies were acceptable. There were no proposed audit adjustments, individually or in the aggregate, having a significant effect on the district's financial reporting process. We identified no instances of fraud, no instances of material noncompliance with laws and regulations. There were no material weaknesses in internal control identified, no material inconsistencies noted with other information contained in the audited financial statements, no disagreements with management on financial accounting and reporting matters, and no serious difficulties encountered in performing the audit, and no major issues discussed with management. Oops. As part of our procedures at the completion of the audit, we received a management representation letter signed by the mayor, the CFO, and the controller. We're unaware of any consultations by management with outside or other accountants. During our client acceptance and throughout the audit, we have performed procedures to ensure we maintained our independence of the district. And lastly, our firm performed no non-attest services for the district during the course of the engagement. The last slide here provides a heads up with regards to accounting pronouncements and current projects of the Governmental Accounting Standards Board, or GASB. Management will need to implement the first two pronouncements, numbers 101 and 102, in the district's fiscal year 2025, and statements number 103 and 104 in fiscal year 2026. The last 4 items noted on this slide are ongoing GASB research projects, the subject matter of which indicates future pronouncements that may be forthcoming. So this concludes our prepared remarks, and we'll be happy to respond to any questions you may have about our fiscal year 2024 independent audit of the district. Thank you.
Thank you, Mr. Kozlik. Mr. Lee.
Good afternoon, Chairman Mendelson and members of the Committee of the Whole. I am Glenn Lee, and I proudly serve as the Chief Financial Officer for the government of the District of Columbia. I am pleased to appear before you today to discuss the fiscal year 2024 Annual Comprehensive Financial Plan, or as we call Acfr. With me today is Kimberly Williams, Deputy CFO and Controller of the District, as well as other members of the OCFO executive team who will assist with answering questions. The solid fiscal year 2024 results are a testament to the district's sound financial management practices and collaboration among many across our government. I want to take this opportunity to acknowledge the hard work and dedication of our many agency program partners in district government who have played a vital role in the successful outcome of fiscal year 2024, including the city administrator and the inspector general who are with us today. We will continue to collaborate with the city administrator and program staff to ensure that audit findings are effectively remediated. Lastly, I want to recognize and congratulate the staff of the OCFO. Noteworthy in evaluating fiscal year 2024 is the fact that this is only the second year of operation of DIFS, which is the district's new enterprise-wide financial system. In this second year, we were able to successfully manage and account for the district's financial resources as attested by the audit, complete the financial audit, and prepare and issue the Acfr on time with an unmodified clean opinion and with no significant deficiencies, otherwise known as Yellow Book findings. For a large institution implementing a new financial system, these are remarkable accomplishments, and we should all be immensely proud. My presentation this afternoon will highlight the key results of the district's the district's fiscal year 2024, after which I am happy to respond to any questions that you may have. So my presentation should be up here in a second. Thank you. I think many of the issues on the next slide, please. We've talked about, again, the 28th consecutive clean opinion with no Yellow Book findings. Our retirement and OPEB trust funds are fully funded. In fact, better than that, and we'll talk about that briefly. Our ratings, our credit ratings remain very strong. And as we've said by many of us many times, the district reserves are at a value of 52 days of working capital. As of the end of fiscal year 2024, the target or the requirement was 60 days. I know it's changed, but for the end of 2024, we were at 52 relative to 60 days was our target. The next two slides show first where resources come from to support the general fund of the district. And this first slide shows that we had $13.5 billion in resources available to the general fund. The most important, or in terms of just size, are income taxes, property taxes, and sales and use taxes. Combined, they were 70% of general fund revenue. Next slide, please. The uses of general fund, specifically, where do we spend this money? We spent roughly $12.4 billion. And about 50% of that was to either education or human support programs, far and away the largest concentrations of our spending. The next largest would be public safety, and then debt service is a close fourth in that list. Next slide, please. Now let's discuss revenues. The first thing we're going to do is look at our revenue performance in 24 relative to fiscal year 2023. Overall, the general fund, very specifically what we commonly refer to as the local fund, grew by, which is where the majority of our budget effort is assigned, grew by $273 million, almost $274 million, which is a growth rate of about 2.6%. Driving general fund growth was a 2.3% or roughly $97 million increase in income taxes. And the important thing about income taxes is that our withholding collections were up 8% from the prior year. Withholding is typically associated with households' wages and salaries they receive. However, non-withholding, which is typically associated with capital gains of various types, was down substantially. But overall, we grew at 2.3% with withholding as a measure of, again, salary and income growing very, very strongly. The second largest contributor to our growth was non-tax revenues, and this primarily was the result of additional revenues of fines and forfeits. Of course, that was driven by the deployment of new automatic traffic enforcement devices. Next in the list, sales tax and property taxes grew between $65 and $70 million each. Sales tax growth was 3.6% and was driven by a substantial increase in hotel tax revenue. Part of that had to do with a tax rate increase, but it still shows underlying very strong growth on a year-over-year basis. For real property, the majority of the growth was associated with higher collection rates. And what does that mean? That means that we not only do we levy what people owe the district, unlike income taxes or sales taxes where the taxpayer tells us what they owe. In the case of property taxes, we determine what people owe. And we always know that that levy we assign, we never receive all 100% for a variety of reasons. And estimating what the actual collection rate, whether it's 96%, 97%, is an integral part of revenue forecasting. What we observed in '24 was a much higher percent of the levy that was actually collected. That's typically associated with strong growth in household income and economic activity, but it did surprise us, and it was the driver of the growth for property tax. A revenue that did not perform as well, in fact, we had year-over-year losses, was deed recordation taxes, and that had to do with the slowing of the real estate market, both for residential and certainly for commercial. And we had fewer estate tax earnings than in prior year. Next slide, please. Okay. So now let's talk about how did the revenues perform relative to our forecast expectation. That is what drives our budgetary surplus, and we'll talk a lot about that. About halfway through the fiscal year, we basically reboot a fiscal year, and it's associated with the overall financial planning and budget process that we have. So in other words, as we were developing the fiscal year 25 through 28 budget, we were also rebalancing fiscal year 24. And at that point in time, our estimate of revenues was $9.98 billion. We actually collected another $255 million relative to that estimate. The two drivers of that was first property tax. And again, it's the same issue. We were pleasantly surprised to see a higher collection rate than anticipated. And that was average for the last several years. And the second category were non-tax revenues. Some of that was technical and some of it was net new. And the technical was that we had a higher portion of reimbursements from prior year activity come into fiscal year 24. So in other words, an expense we may have incurred in 23 or before that we were finally reimbursed for in 24, that amount was much higher than we anticipated. And in addition, we had higher litigation and tax enforcement revenues than we anticipated. We believe all of that is one time and is not sustainable. Nonetheless, it does drive up our budgetary surplus. Let's talk about spending. What this chart shows is our revised budget by cluster, our spending grouping that we have here in the district, and as well as the amount of underspending. As you can see, our revised budget was $11.8 billion, and our underspending was 127. What that means is we spent 127 million less than the $11.8 billion. This means we had an underspending rate of 1.1%. The largest areas in financial and other uses, and there's a caveat about that number that I want to describe a couple slides from now. But overall, this is a very, very modest underspending rate. And I think, as I said last year, that reflects tightening budgets and department directors spending right up to their limit because their budgets are generally less supported than they had been in the past. That's normal given our economic conditions. So that's not a commentary. It's just as budgets get tighter, you tend to spend more of what you're budgeted. Next slide, please. Thank you. So now let's talk about our budgetary surplus. In aggregate, our surplus was 904, almost $905 million. In mid-year, fiscal year 24, during the budget process, we identified $675 million of this surplus and dedicated it, as Chairman Mendelson suggested in his opening remarks, to future spending, the vast majority. However, we enjoyed another roughly $30 million in budgetary surplus, and the sources of that are much of what I described. Both revenues, additional revenues of $255 million, underspending by 127. However, all of that was offset by mandatory commitments that we had, in particular unbudgeted expenses, such as the school advance and different settlements, and also recognition of reductions in transfers into the general fund that we assumed were going to happen back in June. And so there are less resources than we anticipated. All these together explain the origin of the $230 million of additional budgetary surplus. Next slide, please. So then the question is, well, what happened to that surplus? As you see here, we start at the top for $905 million. We committed $675 million of that mid-year through the fiscal year 24 supplemental and 25 through 28 spending plan. And then the next item, remember I mentioned that the underspending in finance and other uses had to be caveated. Here's the deal. We did underspend that by a fair amount of money. However, the majority of the underspending is non-lapsing, which means what we saved or did not spend last year is spent this year. And we expect that to occur. And so therefore, these are not resources that are available for us to spend. They have to be committed in fiscal year 25. Our responsibilities to our bond escrow account increased by $45 million. Our responsibilities to fully fund the emergency reserve increased by $28 million. We had some minor adjustments of $3.5 million, and what was left over was $89 million that went into the fiscal stabilization reserve per recent legislation by the council. As a result, that is the totality of the use of the budgetary surplus. I would like to suggest that 2 years ago, my first time meeting with you for year end, the budgetary surplus was $1.1 billion. Last year it was $400 million. This year it's $229 million. And there's a reason for that. And we'll talk about that shortly. But that is how we deployed this year's reserves. I think I'll skip over the summary of the table there, please. Let's go to the pie chart, the next slide. This is a look at what now is the general fund surplus by different categories. First of all, over 500 million of the $4.9 billion in general fund surplus is dedicated to paying our bond debt service. In other words, throughout the year, we collect a little bit of money, put it into this pool, and then we pay the debt services that comes available. So effectively, it is at the end of the year, a large part of our fund balance. About a week later, we spend most of this on debt service. So if you were to look a week into October, you'd see this number being substantially lower. It goes up and down all through the year. The reserve for dedicated purposes, these are set-asides from revenues, both tax and non-tax, that you have chosen to dedicate to particular programs that have not yet been spent on those programs. And then come the four, what we call mandated reserves, two by the federal government. The federally mandated reserves include both the emergency fund as well as the emergency reserve, as well as the contingency reserve, the fiscal stabilization reserve, and the cash flow reserve. Then finally is the $2.3 billion of basically accumulated surpluses from many years that we have committed to spend over the next 4 years in the financial plan. And to be clear, what we are saying we can do is we can spend more than the revenue we earn in the next 4 years and make up the difference by spending these accumulated surpluses. That was a balanced budget. That's what we agreed to. But at the end of the period, as I suggested to many of you, both privately and in other presentations, that means our fund balance will be roughly half of what it is today by the end of fiscal year 2028. Next slide. This is a more careful look at our reserves, our mandated reserves. The first thing I want you to notice is that one is filled. 2 years ago, all four were filled. And that's the emergency fund. It's mandated by the federal government, along with the contingency, and I'm sure you know what the contingency reserve is used for: unexpected, unanticipated one-time expenses during a fiscal year. We did not have enough budgetary surplus to refill this year. And therefore, per federal law, this fund will be refilled through the budget process that you will begin shortly. The fiscal stabilization, while we did deposit resources as designed through the legislation last summer, is still $167 million from its parameter, and then cash flow is just a little below, at roughly 92% of its parameter. Next slide, please. The good news, and this is stunningly good news, frankly, from my perspective, is that our investments for our post-employment trust funds, both the defined benefit retirement system as well as OPEB, are substantially above full funding. This is extremely rare for states or major cities, and a very, very good outcome. Again, this result changed relative to last year, largely because of performance of the invested assets. Really a good news story. The implications of this is there'll be a slight modification in our required contribution to those systems downward, and that'll be inherent in the budget that you'll see from the mayor. Finally, again, a summary of the important issues. We've covered all of these before. But next slide, please. What's my perspective of the fiscal year 24? Next slide. First, a dot point that's not here is that our financial transaction processes and recording of those transactions work. We have 28 consecutive years of clean audits. The core purpose of the OCFOs being executed, of course, only with the diligent help with the program management staff across the district. So that is something I feel very good about. Financially, we're seeing that current, and of course, as we've described to you, future revenue growth is projected to grow very modestly. In fact, this year's growth of 2.6% is less than the rate of inflation locally. Second, from my point of view, because revenue is growing very slowly, our budgetary surpluses are declining, and this is the fourth point there. The overall performance or use of these budgetary surpluses will become more and more limited as we move forward. The district has adopted practices over the years where we would commit to fully funding reserves, paying some unbudgeted expenses through the surplus. That made sense year after year because surpluses were bountiful. They are no longer bountiful. And that is a major change in our status. We knew that was going to come about, and now we see it actually happening in fiscal year 24. A sign of that is at the end of 22, all of our reserves are full. This year, only one is full. Now, you have to fill one by federal law through the budget process, but that's an outcome. Second is just to reiterate that we are depending on spending half of our fund balance in the next 4 years in order to sustain our spending. That will, we can sustain our operation with doing that, but that leaves very few resources in the future for unanticipated issues. Finally, I think these realities will have an implication on how we formulate the fiscal year 26 through 29 budget plan. In particular, we have to really think about the resources and the expectations of how we have in the past used the budgetary surpluses and realize they're not available any longer. So how do we address these unbudgeted expenses that we know about and commitments to reserves? So those are my takeaways, and I look forward to your questions. Thank you.
Thank you, Mr. Lee. Mr. Donahue.
Good afternoon, Chairman Mendelson, members and staff of the Committee of the Whole. I'm Kevin Donahue, and I am honored to serve as the City Administrator for the District of Columbia. And on behalf of Mayor Muriel Bowser, I am pleased to deliver testimony on the fiscal year 2024 Annual Comprehensive Financial Report, better known as the Acfr. In my presentation, I will discuss the district's strong financial position, the mayor's commitment to responsible fiscal stewardship of our taxpayer dollars, and the economic challenges facing our city in the immediate future. And with that, I will begin my formal presentation. If you go to the next slide. I won't touch upon these before because they've been stated by our CFO, but this was the 28th complete clean audit, a 10th consecutive year with no material weaknesses. We have 52 days of cash on hand, and as CFO Lee just mentioned, our pension funds are robust and our bond ratings are strong. I wanted to reiterate this knowing that CFO Lee would mention it because many cities cannot have on a presentation at their Acfr what the position we're in, and we take maintaining this very seriously. If you go to the next slide, over the past year, we've been working on implementing strategic investments that will make our city safer, improve educational outcomes, and grow our economy. As you can see on the slide, these investments are having a positive impact. We've reduced citywide violent crime by 35% to its lowest levels in 30 years. Our population growth has continued to grow. Tourism has rebounded to record levels. We've created thousands of jobs and increased worker wages. We continue to see more students enroll in our public schools and are proud of gains we have made in our English and math proficiency. We are seeing the opening of more retail, office, residential, hotel, and cultural destinations, and we've broken ground on the transformation of the Capital One Arena and gained control over 170 acres of land at RFK Stadium campus. And just last week, we saw Metro see its highest Monday rush hour ridership since before March 2020. And we continue to remain laser focused on the district's comeback. Go to the next slide. One important component of this, and I'll highlight something again that CFO Lee highlighted, is maintaining the strength of our financial reserve. This is a slide that we have used in each of our presentations over the years that shows visually where they remain. You can see, looking here, we have a full emergency reserve. And as CFO Lee noted, our other reserves remain less than what they need to be under other federal or local law. And we'll maintain, highlight our contingency cash reserve, which is used to respond to unforeseen needs, has not replenished, and by law, this fund must be fully repaid in our upcoming budget submission. One of the reasons we have not built back our reserves is that we experienced the lowest levels of agency underspend in a decade. And if you could change to the next slide. In 2024, and this is a slide that visually represents $132 million of underspend in 2024, represents, as CFO Lee noted, just over 1% of the general fund. The largest component of this is underspending in workforce investment. So that's by design. That's designed to set aside money for our collective bargaining agreements. If you remove that as something that is anomalous to the other underspend, our actual underspend rate was close to 0.5%. And if you note on the slide that CFO Lee mentioned by cluster, some clusters had underspend rates at well below 0.5%. If you go to the next slide, this slide shows just how difficult the upcoming budget formulation will be. As of right now, the only new revenue beyond what we've already budgeted for looking into the out years is spending for spending growth is $44 million. That is less than 1% of the current general fund expenditures of $12.7 billion. In complicating matters, that's not all recurring. The recurring growth in FY28 is just $18.5 million, or just over 1% of general fund's budget. This means without changes, we will only see $44 million of new revenue to invest across government in a recurring way. We like to present the pie chart because it highlights where our money goes in our budget. And if you look at that, and this is something I always often remind people, is our schools, both public schools and charter schools, our healthcare and human services, when combined with those spending that we must do by law, such as interest payment on our debt, represent over 50% of our budget. So visually, you can't even see all the slices of pie on the upper left-hand side because they represent all the other agencies in government. So it's a challenge when we approach a budget that has continuing inflation and relatively modest growth, is that our spending is by definition areas in which we all care so deeply. If you go to the next slide, I will highlight again, as I noted in testimony, some of the other realities we're facing for FY26 budget formulation. In FY25, DC is budgeted for approximately $5.3 billion in federal funds. Of that amount, almost $3.6 billion is federal Medicaid payments. We're reviewing federal directives and guidance through executive orders, guidance from individual federal agencies, and responses to requests for information. There are still many unknown impacts, which may include substantial reductions in funding amounts, and we'll continue to prioritize delivering services. As we receive guidance, we'll also seek to minimize disruptions in service. At the same time, we must be mindful that we cannot spend federal funds that are likely to be frozen or rescinded. Spending those at-risk funds will leave DC taxpayers on the hook to make up for any lost federal resources, which we simply cannot afford to do for the reasons stated in my slide deck and highlighted in CFO Lee's. Based on our analysis of federal guidance, some federal grants most at risk for changes do include the National Electric Vehicle Formula Program, the Greenhouse Gas Emission Fund, and the Home Efficiency and Home Electrification and Appliances Rebates. These respectively provide federal funding to build and construct EV charging stations, to install solar panels for low-income residents, and to assist homeowners with converting gas-powered appliances into electrically powered appliances. And this funding is reimbursement-based, housed at the Treasury Department. As a result, for these particular areas, we have directed DC agencies to pause new spending on these funds while we await additional guidance from federal agencies. As we learn more about the potential impacts to any other federal funds, we will communicate any potential changes and seek to implement them in a way that minimizes disruptions to our residents and our employees. And Mr. Chairman, with your permission, I did bring a table that highlights in detail the different executive orders that we are tracking regarding their potential impact, and we'll make sure that gets emailed out to you and the other members after this hearing. If you go on to the next slide, as we look ahead to our FY26 formulation, we'll use the following guiding principles to make decisions. And this is something similar to what we highlighted last year. First, we want to make sure we invest in the growth of our economy, not only because it provides jobs and wages for individuals, but because when our revenues grow at a rate above inflation, we have the ability to appropriately invest in new services. When our overall revenue growth is below inflation, we wind up making cuts to be able to make our local budget balanced. We'll make sure we maintain, to the best of our ability, core services and protect investments that look at health and safety. We'll prioritize programs that have a data-driven track record of success, and we'll make sure that we realign spending at levels that are consistent with overall growth of our economy and provide more long-term fiscal stability. Before I conclude my presentation, I do want to thank those that put a tremendous amount of work into supporting the Acfr and supporting preparation for this hearing. Director Jenny Reed, who is with me to answer questions, my colleagues at the table who've spoken before me. I also want to particularly thank a member of Director Reed's staff, Josh Tush, who puts a lot of work into prepping me to be able to respond to your questions. It's taken a tremendous amount of work to get to where we are today. Chairman Mendelson, thank you for the opportunity to present today. Myself and Director Reed are both here to answer any questions you and other members have.
Thank you. That's going to conclude the testimony. We have at least, we'll say, one round for questions. We'll see how that goes. I think my first question is, I'm not even sure if it's a question. Mr. Lee, so you in your testimony emphasized that the fund balance, which is over $4 billion, if I remember correctly, I'm not looking at it, is going to be cut maybe as much as in half over the period of the financial plan. And I think you were raising that in conjunction with a concern about liquidity or access to cash.
Yep.
We made some changes with the budget this past year with the Budget Support Act, increasing the cash flow reserve requirement so that overall the reserves will provide about 66 days of cash on hand when full. The idea was that that's a way of having more cash available for liquidity. But we also are, we made some changes to the law, the BSA, as you know, this past year to give you access on a short-term basis, emphasize short-term for cash flow purposes. We also asked for a report, submit quarterly reports on the balance and activities on our reserve funds, and a report on cash flow management that includes recommendations for the optimization and modernization of the district's cash flow management. Where are those reports?
The first one we can provide right away, so I apologize for that. The second one is that we are we underestimated the sophistication of the challenge to forecast the non-general fund resources that we have, the many other funds, and in order to have a complete discussion with you about what resources beyond just the general fund are necessary, we need to have a handle, certainly not only this year, but as we do in a normal course of business, but throughout the financial plan of how those other funds behave and whether they are enough to support our cash needs out of the general fund. Preliminary estimates is yes, they are, but I want to ensure that we have the numbers right and ask for the assistance, whether it's legislative or any other, based on sound analysis. And I'm not comfortable right now with what we understand about the future for a handful of key funds that we will depend upon in order to ensure liquidity. There's also issues that we want to evaluate dealing with the timing of different expenses in the general fund. And I'd like to have that together before we submit that report.
So when do you think we'll get the report?
I'm hoping it's very soon, like within 2 weeks, maybe less. That's my intention. And I need to see a couple more components of our forecast so that we can make specific determinations and requests.
So preliminarily, with what we have done and possibly some further adjustments giving you access to other funds.
Yes.
Your liquidity concerns should be, I want to say satisfied.
They're dramatically remediated, but I'm not sure if they're enough. And I want to be really clear because a report gives us one chance to be very clear and bring our best analytics to the table to figure out if that is adequate. And if it isn't, what are options we can do without asking the council for legislation? So I want to be, this is really important, given where we are with spending our fund balance. I want to be very precise.
Well, I agree that the report should be as thorough, careful, et cetera, but I would not agree that it's one chance. We can always fix
appreciate that.
things again next year and the
Right.
following year. Mr. Donahue, so you spoke of, at the end of your testimony, with regard to several programs federally funded. I wanted to ask you more broadly about concerns with federal funding right now. For example, with what we're hearing in the news about possibly shutting down some federal agencies. I don't know that that's legal, but let's just pretend that that could happen with the voluntary buyouts and so forth. What possible impacts do you foresee, and in particular, unemployment? The unemployment fund.
Let me start with the unemployment. So we know from what we read that there'll be an uptick in unemployment claims. Individuals who work in DC, regardless of where they live, as a reminder for everyone, will take their unemployment from DC. The unemployment trust fund levels are approaching $500 million, which is just under what they were prior to the pandemic, which was the last big strain we had. So they've had a robust growth back to levels that are consistent with what they were prior to 2020. We also are looking closely at the call center at our unemployment insurance office. It is not typically staffed to be able to handle a anomalous surge in claims. So we talk daily with Director Morris Hughes about any supplemental staffing she may need. So as of now, I am confident in the ability of the trust fund to withstand a significant surge, with the caveat that it all depends on the scale and the scale of how many individuals are laid off in a way that would give them unemployment insurance claims. Those who are resigning do not qualify. Those who are laid off will qualify. So if we see a layoffs in the tens of thousands, we have a trust fund that can likely withstand that.
That can
withstand it. If we see something akin to what we had in COVID, which was nearly 100,000 claims of some sort coming for unemployment, that would strain the trust fund. So going in, we're fortunate to have built back that reserve. We'll monitor it closely. We'll work with the OCFO and their team to monitor it to see if any adjustments are needed. But as of now, I don't think we have to make adjustments, aside from looking at the call center capacity.
What about other impacts?
Other impacts, I highlighted one impact in particular, actually 3 funds in my testimony, as a way of highlighting that executive orders come out. They, that in and of themselves, often don't mean anything. They're very important indications of direction. They are literally direction given to federal agencies to begin to make adjustments. So we know they can foreshadow changes we have. We receive changes often then in formal guidance that's provided by federal agencies to our agencies that would change standards, change requirements, change funding levels, freeze funding. In the case of the electrification and solar projects, we received, those were programs specifically called out in the executive order. And there was a subsequent conversation between the federal staff and our staff that they were very, very highly likely to be frozen. So we made adjustments to that to be able to ensure the city's local revenue is not put at risk by pushing funds out when we knew there was going to be a freeze coming. The other changes, if you read the executive orders that we will be sending to all of you after this, they range quite widely from requirements around education to requirements about healthcare and Medicaid. And we watch them closely, but we don't make changes simply based on an executive order without some certainty that it will result in a change that we can appropriately anticipate.
So I want to get a little more specific. The biggest is probably Medicaid. So we don't know for sure what's going to happen there, but based on just news reports, what could the impact look like if it were to actually materialize?
It is a good question. So the largest share of our spending is healthcare and Medicaid. We have about $4.5 billion. I believe that's combined local and federal.
4.5.
$4.5 billion. There's a calculation done called, the shorthand is FMAP, or Federally Medicaid Assistance Percentage. Ours is 70%, that is defined in federal statute. That makes us the 11th highest federal share of our local Medicaid program. Some other states have higher shares. It is typically based on a combination of looking at the percent of higher income and lower income individuals who reside in a particular jurisdiction. Ours is unique because it is set out in federal law. At $4.5 billion, any change of that percentage, just based on the sheer volume of money that is spent, has significant ripple effects. So if that $4.5 billion of 70% were to say go down to 50%, that can represent a $1 billion plus change to local requirements per year that we wouldn't be able to afford. So what I've been instructing and telling directors who ask reasonable questions about all the federal programs, that people should not expect our local revenues to be able to replace federal funding. We just don't have the scale of the federal government. We should be prepared to make adjustments in response to possible federal changes.
So you're struggling to come up with a balanced budget proposal with the Medicaid funding being maintained or continued. If the Medicaid funding is cut by as much as $1 billion, you just said, then does the executive have the ability to scale back the program, or would that be legislation? And what would some of those scale backs look like?
Good afternoon, Chairman. So if I could add to what the city administrator said, if we're looking at $1 billion of lost federal revenue, there's a corresponding local match of 30%. Obviously, that wouldn't be needed anymore. We would need to be making changes to both eligibility and services offered. There is no way that we could come up with $1 billion to replace that revenue. But there are other effects from that as well. So it's not just the healthcare of our residents. If you talk about that money goes directly to providers and hospitals and universities. So you're talking about taking $1 billion of revenue out of their coffers. That will hurt the entire continuum of care for everybody in the district, not just people that rely on Medicaid. Just as a reminder, 1 out of 3 residents in DC is enrolled in Medicaid. In addition, we have many agencies that use Medicaid to provide service. Your health and human service agencies, of course, but also our special education transportation, our DC public schools, and our fire and EMS services rely on Medicaid as well to sustain their budgets. And then lastly, as you know, we have a debt cap that's a % of general fund expenditures. If you're talking about dropping that amount of revenue while the federal doesn't count, there's going to be a local proportion. We're going to take a serious hit on our CIP, and that's mostly funded for roads and bridges and schools. So a big change in FMAP would be very, very catastrophic for the district in ways that wouldn't impact other places like it would us.
So it would impact capital projects like schools and roads. It would impact the entire health system, not just Medicaid recipients. And we would have to make changes to who could participate in Medicaid. We might change rates. That would affect providers, We could change eligibility, for instance, making it closer to the poverty level. And I forget what the other change I was thinking of.
Service levels.
Like, for instance, not providing Medicaid reimbursement for dental services, just as. So those are the kinds of impacts that you foresee if that were to happen.
If that were to happen, that is the range of impacts that I would foresee and that we would have to.
And is the executive able to do that on its own, or would that require council legislation?
If that were to happen, it would be a change to the budget. So it would be done in the budget submission that we would send. It is possible, and this is sort of the timing of this, and certainly we will do everything in our power to advocate for there to not be changes to our Medicaid rates. It's possible that process happens when the council has the budget. So it's possible we will submit a balanced budget to council April 2nd. And if there are changes, and we're talking Medicaid, but there could be changes in many other parts of that affect, and again, not uniquely targeting DC, but like every other state, will be affecting education and healthcare and other areas. So the timing of it, we'll submit the budget based on what we know to be fact at the time of submission. We want to have active, robust dialogue with the council leading up to that, so there are no surprises. But the reconciliation process on the Hill may not come to completion until April or May, during the window when the council's the budget. And I could just note one thing, Mr. Chairman, on this topic, is there's a reason it's important everyone should know why DC has its percentage that is established in federal law. We are not a state. So we have more limited ways to be able to raise revenue and be able to pay for Medicaid matches. As one example, income tax is based on where people live, not where the income is generated. That's just one example of some of the revenue limitations we have because we're not a state, which is partly why our rate is set in federal law, not through the calculation that's typically provided to other states and jurisdictions.
Thank you. Councilmember Robert White, do you have questions?
Yes, Chairman, thank you. And thank you all for the testimonies. The Chairman asked part of a question I was going to ask, but let me go a little further on the potential impacts of federal layoffs and resignations. Do we, Mr. CFO, do we have any projections on how layoffs or resignations would affect our revenue outside of unemployment?
We do not.
Okay.
And the reason is that there are opposing actions happening within the federal government relative to our economy. We understand that federal workers need to be in their offices, and if they work in the district 5 days a week, that's likely to result in many more people coming into the district. However, if there are reductions in staffing, as we hear just, I believe yesterday, an announcement that 40,000 federal employees have taken advantage of the early opt-out. But we don't know how many are here in the district. So that would then reduce the effect of having workers here 5 days a week. And then, of course, what we don't know yet is if entire agencies will move out of the district or, frankly, out of the region to other parts of the country. So it's really, really difficult to piece together what implications we're facing.
Maybe a similarly difficult question on projections. Do you have projections on how the current office occupancy rates affect our economy and how marginal changes like a 10 or 20% increase in occupancy would affect our economy?
Indirectly, the occupancy of buildings and vacancy, economic vacancy, in other words, space in buildings that's no longer leased, are data we track and are part of our property tax forecasting process. So if we perceive there's a large shift one way or the other, it will have an implication on our, not necessarily assessments this year, but our anticipated revenues from property taxes in years forward.
What about other related projections like local spending if more folks are coming into the office?
More than likely, I think that The key issue here is to track the commercial real estate market and the implications. If there's a 15 or 20% swing in office utilization, that's a very large impact on our property tax.
Okay.
So that's where we would concentrate. Clearly, there'll be more street level sales, day-to-day sales between workers and businesses and business to business or agency to business, clearly. And that would be incorporated into our sales tax primarily, those impacts.
Well, what I'm trying to understand in a data-informed way is we're at about 50% occupancy compared to pre-pandemic. What I'm trying to understand is, let's say we got that up another 15, 20%. Would that be good for our economy, or would it be bad in the sense that we should really be looking at adaptive reuse or something else?
If I could clarify your question, what you're saying is, based on many different measures, there is roughly 50% the number of people occupying office space than occurred in January of 2020 right now.
That's
I think
right.
that's what you're referring to.
Yes.
If that were suddenly to decline, such that occupancy is 70%, 75%, unequivocally.
I'm saying if it went up, 10 or 20%, not to 100, not back to where it was January 2020, but if we made it to, like, let's say 70% of where it was.
Unequivocally, that would have positive impacts on our revenues.
Okay.
We would change expectations about office leases and therefore property tax. It would certainly impact sales tax, as I said, and our economists probably could identify 4 or 5 other impacts. So I want to be really clear. That kind of change would have a very positive impact on our economy.
And for you, but then the city administrator may have some thoughts on this. What are your projections on our ability to help pay for a football stadium, whether it's infrastructure or anything else?
To be clear, that is a policy decision with the council and the mayor about how you allocate your budget. And so we forecast the gross.
We got to make it based on some data and projections.
Well, we have projections of our overall revenue and by revenue type. And also working with the city administrator have estimates of costs of existing programs. And we support that effort. Separately, to pull out what you're asking for, no. I mean, the reality is, unless you choose to raise taxes or find other resources, you have to absorb those expenditures like any other program expansion within the existing budget. And that's a budget policy decision, not an estimate that we can provide, if that makes sense.
I hear you.
Yeah.
City
And I would just add, I've worked for this mayor for over 10 years. She's advocated for those 10 years for the city to regain control of our destiny for the 170 acres. She has always made a point of talking about we can debate what we do with it after we get control, but we need control of it. We now have the historic achievement of actually having control of our destiny as to what happens there. There's not an agreement with the team to have a stadium there right now. And the mayor certainly knows that anything that we would do, whether it's housing, entertainment, or other uses, would have to fit fully within the laws that govern our fiduciary responsibilities to taxpayers. But the purpose of RFK is to be able to control what happens to what is right now a dilapidated parking lot and a rusted stadium.
I hear that. What I'm trying to understand is there's enough data for me on Capital One to understand that the investment we made is a good investment, because I look at the revenue we get from it. I look at the number of full-time jobs and part-time jobs and can calculate based on data that this is a good investment for the city. And I'm trying to understand how we should be looking at a football stadium with respect to whether or not it's a good investment.
The way we looked at Capital One is we understood the effect it had on our sales taxes, on the income taxes, on the spillover effect that it has on businesses that are around it, and also what it means and represents in terms of people coming to DC. The way in which we funded Capital One, and sort of I'll remind everyone, it is really, I think, in part some of the unsung heroes in the OCFO, who in the course of refinancing some of our existing debt obligations was able to free up hundreds of millions of dollars of debt capacity that really weeks prior to that offer, we didn't have. So there are mechanisms by which we can, in Monumental, fund a large investment without asking trade-offs that affect the rest of the budget.
And
Understood.
thank you. May I follow up? Thank you.
Briefly, please.
City Administrator, I wanted to say that those same unsung heroes, every time we go to the market, we look to refinance our existing debt portfolio.
Yep.
And we were extraordinarily in a good position on the day that we went to the market. The rates moved in our direction dramatically. Sometimes enormous planning comes down to good timing and luck.
I got two more questions that I've got to get
I
through.
just want to be really clear that we did not do that for a purpose other than that's our duty all the time, is to refinance to save money. So I'm
Understood.
sorry.
I appreciate it. Looking at page 14 of your presentation, this is composition of general fund balance. You mentioned in your testimony the fund balance will be half of what it is today by 2028. What does this mean in terms of budgeting year to year? If we don't do X, then we're going to have half of what we have today in our.
No, sir, this is the balance of our fund balance, in effect, reserves and accumulated surpluses, just a stagnant dollar amount. You are using that in the financial plan that we attested was balanced, these resources in order to sustain your expenditures. So as you spend this, it has no impact on the financial plan. The financial plan depends on you spending this down. The issue I think you're asking is in fiscal year 29, what happens? These resources won't be there. So you'll have to balance the next financial plan knowing you have 2 to 3% fewer dollars to spend than you have from 25 through 28.
So we need to be careful about one-time fund, whether or not we have.
These are one-time resources you're using to sustain the financial plan, and they do. The issue is the year after the financial plan, these resources will not be available. Yes, sir.
Okay. Chairman, I have one last question that should not be long. Referring to page 5 of your presentation, non-tax revenue grew by 10.9%, partially from increased automatic traffic fine revenue. How much has our revenue from traffic fines increased over the past couple fiscal years?
Well, that's not the data I have. I only have an aggregate for all fines and forfeitures. But that revenue stream did grow by other taxes. Now, I believe by 50%. And so what I'd like to do is provide you detail.
Okay.
For that particular revenue over the time period, just to be very clear, because I have an aggregate.
I see the revenue going up, but I don't see the traffic safety results being the same. And so that makes me question, like a lot of residents, whether or not we do this for safety or revenue. And I want us to be very careful about this.
Can I just have a quick addition to his reply? The DDOT has studied very closely in DC when we install traffic enforcement cameras, and they study this by location. There is an unquestioned demonstrated reduction in crashes, injuries, and fatalities. That doesn't mean as a city, we will in aggregate go down, but we know for a fact that when we install traffic cameras around speed and red light cameras in particular, it goes down. So there is a established nexus nationally and in DC for the correlation between those two.
Could you send that data as a follow-up?
Yes, I'd be happy to.
Thank you so much. Thank you, Chairman. And thank you all very much.
Thank you, Councilmember White. Councilmember Fruman.
Thank you very much, and thanks again to the panel. CFO Lee, I really do not envy you having to come up with a revenue estimate in 22 days. The amount of uncertainty that is out there is pretty enormous. So I can imagine you have your heart in your throat about that. One of the things that the chairman asked about was the report on the cash flow and where we are in that. And I think you said 2 weeks, which would be before the revenue estimate, but I think it's really important that we get it either before or contemporaneous with the revenue estimate, because that kicks off the season of all of us thinking about what it is that we need to do. That you can assure that that will
Yes.
happen? Okay. When I looked at the debt service numbers and I saw it was like 9.1%, which with a debt cap of 12%. And then as I looked in out years, it looked like the cost of debt service was actually looked like it would be going down. And so it was going to stay there. My impression had been that we were bumping up against the 12%. So it sort of surprised me to see those numbers. Is that the refinancing? Is that what I'm seeing? What's happening
No,
there?
I'm not sure if I know exactly what you're referring to, Director Reed. Yeah.
Sure. So if you look at the debt service and the 6-year CIP, what you find is that our pinch year is around FY29 or 30. So you can't do any more borrowing now, because if you did, it would bump you up against the cap in the out years. So we have to, if you're going to borrow more now, and we usually pay off our bonds in 25 years, you would bump up against that debt cap in 29 or 30. So that's why it's low now, but you have already, we've almost hit the cap in the 6-year CIP, so we can't add any more now.
Okay. And on the Medicaid discussion that we were having before and the reconciliation, how's the timing of that work? City Administrator Donahue said reconciliation could happen in April, May. Could also take a lot longer than that, but it could happen then. But if it were to happen then, what would the effective date be? Is that for FY26, or is that a thing that we could see hit in April and be effective immediately, and we'd have to deal with it in an even more urgent basis?
We don't know, because it's hard to anticipate how this will really manifest in the reconciliation process. But if there were to be some meaningful changes in our federal funding level that would really implicate local spending, if that happens while the council has the budget, that would, I highlight it because typically we all try to have as much stability as possible during the period of time when the council has the budget. Revenues forecast is fixed, doesn't change until after it's voted on the budget. It's an event that would change the standard pattern of stability and certainty with respect to what to expect over the next 4 years. And I'm just saying that the timing that working with our Intergovernmental Affairs Office, I highlight it because I understand the timing, it very well may land in April or May during the period of time when the budget is open, but the budget's with the council.
Yeah. And one of the things that we're freezing, that you listed, I think, 4 things in the environmental space where the administration has been pretty explicit about what its intentions are. But what happens if they don't do it? Do we then have the money that we can then, hurry up and spend? How's that work? You're being conservative, but what if your conservatism is an overcautiousness?
I don't think it's being overcautious. These particular funds were different than others that may be indirectly alluded to in executive orders, because this executive order is so specific.
Yeah, I don't mean that it's overcautious. That's the wrong word. But what if the worst doesn't happen and they don't do it? Then we would have the money and we could then proceed.
Then we would proceed with, in this case, sending forward further expansions of electrification and solar, knowing we get a federal reimbursement for the work. So we'd be able to do more of that work.
And Council Member, if I could just add, there's there's sort of two parts to these federal grants, right? Some of them are awards that are over 5 or 6 years. So we may be awarded $15 million for vehicle electrification infrastructure, charging infrastructure, sorry, but we only have a few million right now because it's the first year of the award. So those funds could be frozen, rescinded, or they could just cancel future allotments. The other funds we've received, but they're in an account in the US Treasury Department, and we draw them down on a reimbursement-based basis. So as we get clearer guidance from the federal government, if they say, okay, actually, we're not going to rescind these funds, they're not going to be part of budget reconciliation, then theoretically, we should be able to begin spending on them again. But it will depend both on the executive action as well as the congressional action. And both of those are just really uncertain right now.
No, I hear you, but actually, the fact that they are grants over an extended period of time answers what was on my mind, which is if we pause it, but it doesn't happen, then we have more to spend in the balance years for those grants. So that's sort of what I was getting at. In the education space, public education, a couple of things that made me curious. One, we were at about 3.2 billion or 3.3 billion. Then there's a change with the revised budget where it goes down by 300 million. And then there's 478 million that's for FY2025, and that's how you get to the three. So explain that to me.
Sure. So that's the school's advance. So you're seeing the accounting mechanics of the school's advance that we do each summer, where we use contingency or cash flow or one of our reserves to make the first quarter payments to charter schools and a portion to DCPS because they start their operations earlier than October. We then repay it with the budget, and I will defer to the CFO on the specifics of the accounting mechanics there.
Yeah, sure.
Well, if you recall my presentation, there was an extra expense that we called unbudgeted. That's another piece of this puzzle. And in the end, what this is about is providing resources to the schools that are on a different calendar year than what our budget is on. And so over the years, we've developed practices and processes to provide the money that may not be as cleanly budgeted and accounted for as virtually everything else in the district. So you have this forward spending of, what I mean by forward is spending appropriations from a following year in this current year in order to pay for the school's expenses as they start up, but they're starting up at the end of your fiscal year. It is an area I'd love to work with the council and the mayor's office to try to organize a little bit differently, especially as our cash flows become tighter and tighter. But I know enough to be dangerous right now to make any public statements along this line, but it's a very complex set of steps for good reasons that have evolved, but
so I think I'm going to follow up with you a different time because, I mean, what struck me is 330 comes out, 470, 80 come in. And so let's talk a different time. On the pension funds, I asked about this, I think, last year because the market has been so high and I don't think we had as good of a pension fund picture last year as we have this year. And then this year, the explanation is market's doing very well. My understanding was that the way in which the actuarials look at the market is over a number of year period. And so maybe we lost a bad year and got a good year, and so that really improves the picture. Makes me think that that will be pretty resilient going forward because we have had better and better years, so the picture looks good. But tell me if I'm right on that, if I'm understanding
you are.
that.
The purpose of multi-year smoothing is the term. In other words, basically a unweighted average of multiple years of the value of the portfolio is to avoid large shifts in required contributions for employers and employees. In other words, if you have a portfolio that's very volatile, and some years you're up a lot, some years you're down, if you were to then set, based on that value, what the required contribution of the employer's employees are, there'd be radical changes every year. So there's these devices have been set up in order to average out the movement of your asset value so that the changes are minimized.
Okay, so I'm closing out, but thank you for that. That is a piece of good news because that's going to extend through the financial plan, I would expect, and help on things, lower costs, not just this year, but further into the financial plan. Another piece of good news is we're hearing sounds from WMATA as if their needs may not be as large in the coming year as we had feared. Maybe that can help us as well in a difficult period.
We'll see.
If I could just add, council member, I mean, the need for the growth in the WMATA subsidy is not as large as last year, but right now we're looking at a $77 million year-over-year increase based on the budget that they presented us. So it's still a lot.
As opposed to 220 or 230
Right, as
last
opposed
year.
to 200 million last year.
But the reality is you still have a 3% growth. And in addition, they used fund balance to balance this year, and they want the 3 jurisdictions to contribute on a permanent basis that additional fund balance that is no longer available.
All right, well, I'd love to ask more questions, but I can't. Thank you.
Ms. Reed, is that 77 million in lieu of the 200 million that we did last year, or is that 77 million on top of the 200 million?
77 on top of the 200 million that we did
Okay.
last year.
And if I could just add with regard to Councilmember Fruman, in response to your question on the pension. So the police, fire, and teachers' pensions may be 110% funded, but the calculation for the annual contribution is not based on that. It's based on this smoothing. So there are 2 different figures. The annual contribution is calculated by the actuary looking at the smoothing over a period of time. The percentage funded is just a separate calculation that tells us that on September 30th, it was 110% funded.
If I could just add, so the practical effect of that is our 25 contributions do not change. Our projected contributions that we need to plan for in the financial plan get adjusted based on these recent numbers from the actuaries. Those will be different. They will be lower. So that will be good news.
Right, they're related, the numbers, but not the same. Thank you.
Councilmember Parker.
Thank you. CFO Lee, your presentation states that federally and locally mandated reserves equal 52 days of working capital and that the recommendation is 60 days. Could you explain why 60 days is the recommendation and whether you will insist on the mayor and the council funding the reserves to that level this budget cycle?
60 days is the best thought of as a best practice that the industry or the public finance industry expects. The reality is that that day amount really is varies from jurisdiction to jurisdiction based on the jurisdiction's liquidity needs or frequency of emergencies or unplanned expenses. There are in cases where just at the extreme, you have a liquidity need that's substantially above 60 days, you need more than that in your bank account, in your reserves. So in general, 60 days is thought to be a best practice, but it does come down to each jurisdiction determining how much money it has to have available to pay its bills or the frequency of unknown expenses that may require a higher set aside. If you're an area that's adjacent to events that are catastrophic, I'm thinking of high earthquake zone areas or heavy hurricane areas, you probably want more than 60 days because you face dramatic events that you have to spend money on fairly frequently.
I got it. And will you insist that the mayor and council fill those reserves during this budget process?
Well, the most important reserve to fill is a mandate by federal law. that in fiscal year 25 and 26, the contingency fund, which is contingency reserve, is fully filled through budget action or a surplus somewhere, but most likely budget action. That neither the mayor or council have a choice over. The
No,
issue is
I'm clear on that. And based on your report, it seems as though that reserve is full.
It is
And
not.
as you
It is not.
and as you said it again.
It is not. It will require, I believe, about $155 million of resources in order to fill it over the 2-year period.
And so for the other reserves, I'm taking that you will not insist that the council or the mayor have to fill those reserves this budget cycle.
I think it's too soon to determine what our reserves are. As you heard earlier, we're working very hard to have a much more detailed understanding of our cash needs in the future. And if our analysis that we're working on that Mr. Mendelson described indicates that we actually are in a position by spending all of our existing accumulated surpluses, then not having resources to pay bills, then that's a discussion we have to have. What kind of
Got it.
strategies do we put in?
Got it. From a layperson's perspective, it seems that the commercial real estate transactions picked up in Q1 of this fiscal year. Is that what you're seeing? And do you expect the deed and recordation taxes to level off or pick up again?
Well, we will make a judgment on that very clearly at the end of the month when we provide a new revenue forecast. Yes, the sales are up. Whether that's sustainable or not, our economists are still trying to determine. So I acknowledge it's up. The transactions could be up relative to what we just experienced, but we will be able to answer that very specifically with our forecast that's due the end of February.
Got it. I did have a question about the pensions and benefits that exceed 100%, but the chairman addressed that. So I'll bypass that question. Could you describe the status of any payment in lieu of tax agreements in existence in the district? What, if any, organizations are making such payments?
Off the top of my head, no, I can't, but I'm happy to provide you a paper that describes the current status.
Yes, and they are some are referred to in the Acfr.
Yes,
And so,
right.
yes, if you
Right.
could provide not only who, but the extent to which that funding is going
Yes,
towards supporting programs, that would be helpful.
yes, happy to.
How much revenue does the district forego annually in tax spending through, for instance, tax abatements?
We publish a report every year that documents what our tax expenditures are. Dr. Lee, Fitzroy Lee, our economist. Yeah, while we're, if you'd like to ask another question, we'll come up with our latest estimate of that value. I don't have it off the top of my head, but Dr. Lee, our chief forecaster, is looking it up right now, so we'd be happy to
Okay,
answer.
and after this, we'll pivot to the city administrator. Has your team done any assessment or analysis of our significant investments downtown? Less to argue whether or not we should invest downtown, but to analyze whether the strategy we're putting forth as a district is the right one.
That's to me.
Yes.
Yes. These programs are relatively new, and it would take a handful of years, certainly several quarters, to understand the implications. Just from my experience and my perspective, any efforts to stimulate our economy in downtown will be, if not in the immediate run, in the longer run, good strategies. Now,
Okay,
what those strategies, right, go ahead.
Yes, I'm going to push a little bit.
Sure,
I
please.
imagine we're going to be requested to make additional investments downtown, and yes, we should do that. But I do worry that we are kind of blindly making adjustments to programs, giving away tax abatements, foregoing policies. with no real assessment whether or not it's paying off. I know that, for instance, there were two large conversion programs running downtown, and this is maybe a great opportunity to pivot to the city administrator. Where do we stand, or is there an analysis that the mayor or your team can provide around how we're seeing returns on those investments?
We are able to provide you information in response to the question that provides some detail as to what we expect to receive. What I will talk about is the two programs that you referenced. One is the Housing Conversion Tax Abatement Program. That is meant to be able to convert commercial real estate into housing, understanding that downtown has to look different in the future than it did prior to 2020. There are nearly 1,000 units that we have approved for development that are utilizing the tax abatement since we rolled that out. DC leads the country, I believe, in the percent and number of downtown conversions that are occurring, despite not being the largest city in the country. The other program, which is what we call Office to Anything, recognizes that people may want to convert a commercial real estate building into a hotel, something different than housing. And that program is just funded in this budget, so the rules and regulations are still being rolled out. The fundamental question you ask is to why do we choose this versus other investments? We base it on the data we get from the CFO around what is limiting our revenue growth that has an impact on all of our programs, and it is clearly commercial real estate. Second, we have a significant amount of outreach to individuals who own or manage the properties to understand what level of investment and what type of investment would trigger something that would only happen with that investment. So the two programs were built based on feedback aimed at what we know to be the primary driver of revenue being held back. And the results, at least for office to housing, are robust. We have almost 1,000 units through the program that I believe would not otherwise happen.
That is great news. But it is also helpful to know how we're tracking that so that we can make more informed decisions. One more quick follow-up. In looking at the criteria that the mayor will be using to determine her budgetary investments, can you speak to who or how you're determining the long-term fiscal stability as a criteria? And I imagine that may be used around RFK, for instance. How are you assessing what investments may project towards long-term fiscal stability?
There's two ways we do that. It's an outstanding question. One is working with our Deputy Mayor for Planning and Economic Development. We do analyze what we believe to be the impact of specific investments meant to spur growth. In addition to that, my reference to long-term stability was also referring to we have programs that are popular, that are good, that help people out, in which the very structure of the program produces growth in its costs that we know are well above our revenue growth. So we have to be able to make changes to those programs that ensure that even if we can find one-time savings now, we know we can fund it over the course of our financial plan. So we're looking at program growth and its drivers in a very meticulous, detailed way to be able to change programs so that they are growing at a rate consistent with their revenue. And those programs cut across healthcare, education, human services, transportation. It will cut across each agency in which we see cost growth that we know is structurally elevated beyond where it should be.
Love it. One last quick follow-up, and I hope the Pay Equity Fund is in that category. Back to CFO Lee. Obviously, DC faces a lot of potential impacts from decisions made by Congress and the president. Under what circumstances, in your view, might the use of the district's reserves be appropriate?
The district's reserves should be used for their intended purposes. So the emergency reserve, for example, is a catastrophic unplanned event that we have to deal with, whatever that looks like. The contingency reserve is, if you're looking for an answer about should we use those to support ongoing programs, no, I think that is not a wise.
No, but for instance, if there's a mass firing of federal employees who are district residents, would that, in your view, be an effective use of the district's reserves?
I believe that that's not, if that's consistent with our current uses, but with the current legislation that establishes those. However, I think certainly the district's reserves are primarily established for cash flow purposes. So in other words, if we use these reserves, they don't exist in, let's say, a year, and we don't have enough money on hand to make payroll for district employees, then no, that makes no sense.
Well, thank you both for your time. I'll just end by saying, I think it's going to be incredibly important that we as a government align on when and how we use those reserves. Thank you.
Oh, thank you, Councilmember Parker. Councilmember Henderson?
Thank you, Mr. Chairman, and good afternoon. One of the joys of sort of going in the middle of the pack is that many questions have already been asked, but it also gives you an opportunity to follow up. So one of the things I did want to follow up on, CFO Lee, I think Chairman Mendelson asked about this from the Budget Support Act requirement regarding the report about an evaluation of the district cash flow management practices, et cetera. Is that something we'll get before the budget in
Yes.
April? Okay,
Yes.
just wanted to confirm
Long
that.
before that, yes.
Okay. One of the things that I found concerning with the Acfr is the acknowledgement that the poverty rate went up in the district in 2024 from 12.5% in 2023 to 14% in 2024. I'm curious, which definition do we use in terms of how we define poverty?
Our controller who assembles this information may be able to provide that information. Did we receive it from?
We get it from another source. Let me find the source.
We'll answer that in a second.
Okay. While they're looking for that,
Yes.
I guess my question for the city administrator is, this increase in the poverty rate, and for that matter, in several other reports we've seen in terms of an increase in food insecurity and otherwise, is coming at a time when, as you mentioned, a lot of social safety net programs across the country are kind of facing an uncertain future. And so when we're looking at contingency or otherwise, I have to assume that you all are doing some mass exercise of option A, option B, option C, et cetera.
We are assessing the range of impacts that some of the federal changes can have, yes.
Okay, I think it would be helpful to the extent possible that there can be conversations with folks in the legislature about some of these variety of things. A lot of what you brought up as I chair the health committee is in my cluster. And, the more that we can sort of inform people about the realities of uncertainty, I think the better it is. So folks don't necessarily feel like the rug is being pulled out from under them if we have to make significant changes to some of these programs.
You have our commitment to be collaborative with the council leading up to the budget. Given the unusual changes that could happen and the stakes involved, we do want to try to make sure we minimize the surprises and we take all of that analysis very seriously.
Great.
Sorry, council member, if I could just add, just on your note about the poverty rate going up in DC, we too are not happy to see that. I do think a lot of that is due to the fact that so much of the federal stimulus funds that were flowing, providing additional assistance to residents through additional tax credits, payments, right, that help bring the poverty rate down, not only in DC, but nationally. Now that those have gone away, it's certainly impacting families. And then just, are you asking whether or not we're measuring poverty using the regular Census Bureau rate or the supplemental rate?
Yes.
Okay. I believe it's the regular rate, but I thought that.
That's our understanding, yes.
Oh, okay.
Yeah,
I was just,
yeah.
for folks who are out there, there are different rates
Right.
and definitions. And so I was just curious in terms of that one. Okay. I wanted to ask about capital costs and debt service.
Mhm.
So there's an exhibit in your nicely fine book, S-1D, that shows our expenditures on debt service have nearly doubled over the past 10 years. But so has our budget. So, which is tied up in our debt cap of 12%. For those who don't have the chart, in 2015, we were spending about $731 million on debt service. And in 2024, we're spending about $1.4 billion on debt service.
Mm-hmm.
Is this ballooning attributable to anything other than our debt capacity rising with our budget increases?
My understanding is it's not. It just reflects the fact that that's the measure of debt capacity is how much debt service we pay relative to the general government.
Okay,
Now, the general fund spending.
okay.
Perhaps others with deeper history here would know better than I, but that's what I understand to be true. So if your limit is growing by 3% a year or
Yeah.
5% a year, then
Okay, I
that
just want to make
provides
sure
more
that there is not
capacity.
something else that we're not necessarily seeing there.
Sorry,
oh,
Councilmember, if I
yes.
could just add, in addition to what the CFO said, which I absolutely agree with, you know, the dollar we spent in 2015 does not go as far as the dollar we're trying to spend today.
Yes.
So I do think, while some of that is just natural growth, also that growth isn't going as far for the same type of project, right? Everything costs more to build.
Yeah, and you add tariffs onto that and it will continue to cost more.
Yes.
In that regard, right, we've done a really good job, I feel like, in the city in terms of our infrastructure projects, whether it be IT, roads, bridges, our schools, our libraries, et cetera. But the Acfr notes that we still have another $3 billion worth of infrastructure needs, including deferred maintenance. The deferred maintenance part gives me a little heartburn because it, you know, the larger you get on deferred maintenance, the further you push it out, the bigger the cost at the end will be. With that, how much longer can we expect our debt service to be as high as it is? Is this something we're going to be?
I think that's a budget decision as long as it's under the cap. That at some level, it's up to the decision makers, the mayor's office and you all to decide how much of the general fund is committed to debt service.
Okay.
The one thing I'd like to say about debt service, it's another intangible or tangent relative to your main question, is that do appreciate that right now Congress is considering to take legislative action to eliminate the tax deductibility of municipal bonds. Right now, if you own a bond from a state or local authority, you don't have to pay interest on the interest you earn. You don't have to pay income tax on the interest you earn. As a balancing measure to other tax reductions, Congress is considering all versions of a path to balance the reductions, tax reductions, require some elimination of the municipal income tax deductibility. And that will radically change our capital program. Overnight, our costs moving forward will go up 25% or more because we will be paying much higher interest costs. So I think I understand your line of questions. What I'm saying is there's this huge risk that's in front of us in terms of a public sector entity trying to manage its capital program.
Oh, as I sort of mentioned to you, right, the group chats of policymakers across the country that I'm a part of are having these very similar conversations, and it is very murky for all of us to be making decisions in the light of uncertainty of what's happening with the Congress. But I guess I'm just trying to control what I can control for today, because who knows how long it's going to take them to get their act together on whatever they are deciding to do on that front. In that regard, as we think about some of the ways for which we can lower capital costs or not, I know, Mr. CFO, you often are saying, you know, that's a policy decision, that's a you know, a budgetary decision, but has there been any analysis that's been done about whether or not some projects' costs could be reduced through better project management, for instance, or oversight over the capital construction costs?
I'm not aware of our office doing that kind of assessment.
Mr. City Administrator, is that something that your office has engaged in?
We do look very closely at how we can more efficiently buy things. Often that's based on getting ahead of inflation. So trying to move projects and the procurement of commodities sooner in the project. I will highlight that we as sort of collective policymakers do instill policies, many of them good, that we know have the practical effect of increasing the cost of building a school or rec center. We have a project labor agreement requirement that every construction company, every bidder will say adds 10 to 15% to a project. We have environmental requirements, all very good, that all the engineers say add 5 to 10, sometimes 12% to a project. So much beyond the efficiency of our project management, we do have policies that are very well intended that do have the practical trade-off of making vertical and horizontal constructions more expensive than we would without those policies.
Yep, thank you. Inspector General Lucas, I don't want to leave you out here just to sit. I want to ask a question around instances of fraud. You know, as I'm in the health cluster, so I get your emails around when we have bad actors in certain parts of our system. It just, everyone else has gone on, so I'm just keep talking. I'm curious to the extent that you are working closely with our agencies, particularly those in the health cluster, around audits to ensure that we don't have actors who are taking advantage of the system, but also that we are able to recoup dollars for which were wrongly paid out.
Yeah, my office is always looking to work closely with agencies to be preventative, to try and find things before they, become bad, before they become fraud. And often what we find is that some agencies, don't want our help because they don't want to be exposed as not having good processes. We do have a program called ICAP, which is the Internal Control Assessment Program, is where we come in and be a good neighbor to agencies and say, hey, if you improve here, you will be better stewards of government money. We haven't had anyone take us up on that program.
Wait, when did you launch this program?
We created it during COVID, and we've been trying to get folks to utilize it ever since. It's been a difficult proposition.
I have some suggestions, but we could talk about that
Okay.
offline.
I look forward to that.
All right, thank you. Thank you, Mr. Chairman.
Thank you, Councilmember Henderson. Councilmember Pinto.
Thank you, Mr. Chairman. Thank you all for being here today and on this important report and review. I want to start, Mr. City Administrator, with some questions around some underspending. I see that one's underspent by 1.5 million in fiscal year 2024. Their budget was already revised down in that year's budget from 30 million annually to 25 million annually. So what can be attributed for that underspending?
For the ones office, I believe it is largely attributed to vacancies and vacancies that were open throughout the year producing the underspend.
I'm sorry, I didn't hear that last part.
Vacancies that were open producing underspend at the end of the year.
Okay. Are you anticipating that they will be filling those vacancies and then meet the budget goals for the rest of the year?
I certainly hope so. Yes, it is my expectation that they fill vacancies to the best of their ability.
Okay, there were no kind of programmatic or system policy changes that took place in any of the ones programs that yielded?
No, there's sometimes natural underspending in both contracts and vacancies. To my knowledge, there was not at the ones office a change in policy or program that contributed to the underspend.
Okay.
I think it was a natural course of letting contracts, receiving invoices, and trying to fill positions.
Okay, thank you. For OVSJG, the original FY24 budget was 104.9 million, but then was revised down to 95 million. The agency underspent by 2.8 million, which is, of course, an agency which issues grants to many applicants waiting for funding. What do you attribute this underspending for?
From my understanding, it is attributed to contracts and grants. I would have to get back to you on the specific contracts and grants that produce the underspending within their portfolio.
Okay, I think contracts and grants is probably a fair, I don't want to call it a guess, but a fair estimate, because most of their budget is based off of that, but in an agency that is issuing contracts and grants as almost their entire budget, that is a worrisome number when we still hear from so many applicants who are waiting on their fund disbursements.
Yeah, and if I could just add, council member, that there was a little bit of salary lapse, as there are for most agencies in OVSJG, but the majority was grants and contracts. What we find is sometimes that grantees, while we may make an award, don't necessarily always have expenditures that they can submit in time to be reimbursed for. And so I believe that was some of the case with OVSJG. It is larger than it's been in years past. And so I know that the director has been working to really make sure the process is tightened up so that we don't have that kind of underspending in those functions.
Got it. Thank you very much. Can you, CFO Lehigh, can you provide an update on what we're seeing in the commercial and office real estate market, and what trends you're anticipating over the next 5 years?
Over the next 5 years, yes, we have to make that call, of course, for our revenue forecast. Anecdotally, we understand that the market could be bottoming out, but perhaps that's just a sense of pre-COVID leases that are finally expiring. And so we are more certain on where the most amount of vacancies will occur, vacancy economic, in other words, properties not being leased. I would caution, however, is that certainly in the district, there is enormous volatility associated with federal employment. And until we understand the full amount of change that'll happen to the federal workforce as a result of administration or congressional actions, it's really hard to think of we're at a point where we're turning around and moving forward. Because if suddenly 2 or 3 agencies are relocated out of the district, or there is a severe downturn in number of employees, we could have another round of properties that are, for all intents and purposes, still leased that now will have no market. Or perhaps the federal government is able to release a lot of buildings that are not suited for other things other than office. And then we have a substantial number of new Class A, Class B, maybe even Class C office on the market, which would have the effect of pulling the whole market down. So I think it's a very volatile time to make that call.
There are a lot of different stakeholders and players that will impact our commercial real estate market. And, of course, we need the private sector to act. There are other policy or legislative interventions that we can think of. And we have been working together over the last several of years to try to create some of those incentives and programs. There are also kind of administrative things that CFO's office can be doing when it comes to the valuation of our buildings. Have you and your team made any progress on exploring things like the timeline of when a building is assessed, or working with property owners to have a valuation that is less subject to being appealed?
Sure. Yes, we're looking at the entire value chain of establishing assessed value. Certainly, as I'm sure you know, many other council members have spoke to me about this, there is established in law a contradictory approach to receiving information from property owners in order to establish assessed value, especially for commercial properties, where we have to make an assessed value call on a property, and then within about 8 weeks later, we receive a new set of information about their profitability for the prior year. That could materially have changed our assessed value, but our value was had to be set by law 8 weeks earlier. And so right now, our opinion is that changing the reporting requirements or assessed value time period would be a good move in order to at least streamline that process so we have the most up-to-date information available to us to make determinations for commercial properties.
And so is it your view that that would need to be a legislative change? That's
It
not
is,
something
yes.
you can do
Yes.
administratively?
Mhm.
Okay, thank you. Your report outlines that we see individual income taxes increasing by 3%. Is that more attributable to people's incomes going up or more people themselves moving to the district?
Well, probably a bit of both, because if you have more taxpayers, your overall taxable household income increases. But also we know there's strong wage growth in the mid to upper levels of the economy right now, relatively strong. And so it's a mix of the two. The bottom line is the taxable salary and wages that are normally, the taxes are paid through a withholding mechanism. We're up in 24, 8% over 23.
Is that something we track though? Of
Yes.
how many people are moving into the district and what we're gaining from their income taxes?
I don't believe we identify people who are net new from the perspective of the total population changes. Clearly, we know people who are new to the district, but if your overall population is not growing, that doesn't mean anything. They're just people moving in, there's others moving out. I don't think we isolate the, let's say, 14,000 that we just experienced, which was a very good thing in the longer run. You know, we don't have a mechanism to decide who those people are and then track their income tax.
Last year, one of the largest, if not the largest cohort of people leaving the district was young parents with young children, young families, I should say. Is that still a trend that we're seeing?
Yeah, we don't have any update relative to our previous statements that yes, that is a trend. That's a post-COVID trend or a COVID trend. That the last time we had updated information indicated was still happening, maybe not at the same levels. But it's happened, it's happening with all major cities across the country, as you know.
Okay. How do you reconcile the real property tax increase of 2.7% in your report versus concerns that we're facing a real property tax cliff with our commercial market?
Well, a large portion of assessed value are residential properties, and by any measure, their values are increasing. Also, a large portion of commercial value is not offices, but other things, hotels, retail space, and so forth, warehousing. And in many of those markets, their values are increasing as well. Certainly, commercial office space is declining, and that's reflected in our forecast and will be moving forward. But there are other components to assessed value that are still growing.
But if the total real property taxes increased, then should we expect that those other markets for residential and hotel will outpace the decreases that we're seeing in the office market? Or is it expected to, in the next several years, that will be offset by the decreases we're seeing in office?
Unclear right now because it's, as I said, it's difficult to know just how deeply we'll lose value in the commercial office space. We are making that call. We have to for the forecast, but it's highly volatile right now.
Thank you. Thank you all. Thank you, Mr. Chairman.
Thank you, Councilmember Pinto. Councilmember Bonds.
Thank you all again for being here. I have a couple of questions. What are some of the hospitality sources of the revenue increase we see in sales tax? Would it include, for instance, our arena, things like that, or is it more granular like liquor sales or something like that?
What we're seeing is the taxable income associated with hotels is growing. So that hotel rents, charges that are subject to our sales tax is growing substantially. So that would reflect either higher prices for rooms they're renting or a higher rate of rooms, and I think both are happening. And so that pulls that phenomena of hotels and how their gross receipts are growing is a significant part of our revenue growth, certainly sales tax.
All right. So as it relates to the arena, are we seeing an increase in sales tax from the arena?
Couple
Or
issues there
is that
for the,
too small?
yeah, no,
Universe.
couple things. There are particular taxes that we can't talk about because it's a single taxpayer. So overall, it's early in any part of their development to really understand what the implications are. Maybe I'm not understanding your question.
All right. I know that as it relates to the arenas, as it relates to the various sports locations that we have,
Right.
that there is a tax on food and beverage. I
Yes.
know that. All right. And ticket sales. And so
Yes.
I'm really asking, are we showing any growth in ticket sales as an example?
There is disclosure information that I need to be very careful about. So what I'd like to do is work with my team to provide an answer about what revenues we can disclose about sports in general, sports activity in general. Because
I know there are other taxes
yeah,
or
they're right.
fees as well. I didn't realize it was proprietary.
Some is. Yeah.
Because we vote on it and
Right.
spend money on the infrastructure, so.
I understand.
Okay, but would love to know.
I need to be
what-
very careful, so I would
Yes.
request that we follow up with an answer.
All right, so on our borrowing limit or debt cap, are there conditions that would trigger a reduction in the cap limit?
Not that I'm aware.
Okay,
I believe that's a statutory limit by the council and mayor or by the district itself.
all right.
So-
And so would there be situations that would happen in the marketplace, in our community, that would cause you to recommend that we need to lower that cap?
I can't imagine that now. Now, the reality is, I think as Director Reed was pointing out, if there are catastrophic events that require the general fund spending to go down, since the cap is tied to general fund spending, there'd be less room. In other words, what you could spend on debt service would have to decline.
All right. Okay. That's what I thought, so thank you for reiterating that. Has consideration been given to the possible increase in volume of commercial space needed to accommodate, let's say, lobbyists and others that wish to be close to the new White House and the federal interests?
I'm sorry,
I'm thinking about the commercial space that we have.
yes.
Understanding that there's a tremendous vacancy now, and wondering if we have thought about moving into future planning, whether or not there may be an opportunity to occupy those spaces because there are individuals and organizations, lobbyists that would like to be in the District of Columbia that are not here today.
Perhaps the city administrator can talk to
All right,
the different
thank you.
conversion programs are working.
Thank you.
I would just highlight, we do have a vitality fund that's been proposed by the mayor, funded by council as we pass through the budget. That is meant to attract businesses and it has requirements. One requirement is that the employees be in person, so that the benefit of that is not just the business being located here, but there's a ripple effect on the sales tax. So we do actively recruit businesses, and clearly if there's an uptick in interest in a particular industry, it will also help stabilize and improve our commercial real estate portfolio in the city.
All right, another question I have is regarding the cost of traffic cameras. what is the cost, the impact that we expect in the current budget and the budget moving forward in 26, 27? I guess it's based on what we anticipate to be the volume of new cameras, I suppose, and the upkeep of the existing camera system. They're done through contracts. We all know that. And so I'm asking about that.
Yeah, so there's about $1 billion, I believe, across the entire financial plan that would be attributable to automated traffic enforcement. That reflects in FY24, we proposed and the council approved an expansion to other safety sensitive areas. That installation of additional cameras has largely happened. In addition, we put cameras on buses for the first time to enforce bus lanes, put them on Aussie school buses for the first time to help enforce people trying to get around them. So we are seeing the impacts right now. There's not another planned expansion. And then we will see how the revenues come in, but it's about $1 billion over 4 years.
All right. Thank you very much for that. And I also want to know a little bit about whether or not there have been revenue estimates of income that we could raise by adding, I know this is interesting, a modest property tax on universities and religious-owned housing.
Through our normal processes, we're happy to evaluate a proposal like that. So there's some definitions that we'd have to understand. Something right off the cuff. We can't provide a number, but we would be happy to work on a proposal like that.
All right. And in the category of non-tax, which is listed showing a growth of 10.9%, does that include collections that we have from the fraud cases, Mr. Lucas, as an example? Okay.
Could you repeat that question?
Under non-tax revenue, you say it grew by 10.9%. And I know you've talked, or the panel has spoken about the automatic traffic cameras. I'm wondering if in that category, we would find the recapturing of monies from fraud.
Yeah, I'm not sure. CFO may be able to answer.
Yes.
All
The
right.
answer is yes.
Thank you very much.
Yep.
Thank you. Thank you, Chairman.
Thank you, Councilmember. I have a couple more questions. First, with regard to the draws on the contingency fund, contingency reserves, we're supposed to get a quarterly report. I touched on this earlier. I focused on it a little bit more while listening to other members. We have not gotten the fourth quarter report from fiscal year 24. And we have not gotten the quarterly report for the first quarter of fiscal year 25.
Okay, that's a mistake.
And have those reports been done?
They are certainly something we can compile, so I can't
I
speak
think
to-
you're being,
Yes.
Good afternoon. The report for the fourth quarter can't be issued until after the Acfr, so that will be coming to you very shortly. And the third quarter report you would have received on September
I think it was the first quarter of this year, 25.
First quarter is not, we can't calculate that one yet.
Right. Okay.
I didn't hear that.
We can't calculate that one yet. You should be receiving that one shortly.
There is, with all of these reports, and I'm speaking of other agencies as well, an issue of timeliness. I mean, we would kind of like to know as close to the quarter what the draws are. And I would think that the draws are listed on a cumulative basis. So draw on the October 10th, you put that on the list. On December 3rd, you put that on the list. On December 31st, the list is complete. I know I might have oversimplified it, but here we are in February. It'd be nice to get the reports more timely. Why can we not get the fourth quarter in October of the year? Why does it have to wait for the Acfr? It's not
Because
an audited statement.
we're still reconciling the balances and we want to make sure that they're accurate.
Well, how about if you give us an unaudited report and then you can revise it if necessary?
Well, we could give you an unaudited report, but also remember that we do, every time there is a draw on the contingency, you do receive a report on the fact that there was a draw. But we can certainly, if you would like to have an interim report, we can certainly work with you to do that.
Yes, I would. And continuing with regard to the contingency reserve, so does that have to be repaid in full? It's like $155 million. Does it have to be repaid in full in FY26 and FY27, or FY25, which we've already budgeted, and FY26?
My understanding it's fiscal year 25 and 26. That's the time period. That's our reading of the code.
So we're halfway through the year, and we now have to find out of what's left in the net last half of the year, money to repay the contingency draws.
When we submit our FY25 supplemental and 26 budget in early April, we'll fully repay the contingency. And it'll be reflected in those documents.
Anything more on that? There's some people who've gotten no questions. So there were 4 open prior year recommendations.
Correct.
Why, in your observation, are those not resolved?
The first 2 were at Octo. These were perennial issues that we've identified. One predates our involvement, goes back to 2018. Yes, I think it could be resource constraints. It could be a lack of will to want to fix it. Again, the vulnerability assessments and the risk framework analysis that needs to be done, I understand is a heavy lift, and they're still ongoing in terms of their remediation efforts.
So when you go in, or your folks go in and look at, and you mentioned Octo, I think 2 are Octo, one's OSSI, one's Office of Contracting and Procurement.
Correct.
Aren't your folks going, oh, Lord, here they are again? And then aren't you sort of trying to figure out why? Are they being lazy? Are they being rebellious, as in don't want to do it?
I don't think, I wouldn't characterize it that way. I mean, it's simply, it's taking them longer than anticipated. The 2 at OSSI and OCP, we had current year exceptions. So we kind of back into those saying, okay, if you had exceptions, clearly the controls weren't, effective. And if the controls weren't effective, then your remediation efforts are clearly then still ongoing. So it really just depends on, I mean, we're always there in everyone's favorite time of year, right? When the auditor comes. But it's a matter of.
I like seeing you. So.
Well, thank you. But again, we simply look at the facts and the condition that, the books and records are in, and that's what we report on.
So, Mr. Lucas, you're responsible for waste, fraud, and abuse. That is not causing it, but stopping it. And the control concern should be your concern. So what are you doing to crack the whip on these agencies?
Not much. I have had conversations with the administration, particularly around OSSI. Not OSSI, but Octo. My understanding is it's a resource constraint, which is why it's taking so long to fully remediate. But in general, with all of the recommendations that the auditors have made, the administration as well as the CFO do a fairly good job of remediating these. But these 4 have been a challenge to fully remediate.
Well, one's from 2018 and one's from 2021. Do you do management alert letters midway through the year saying, hey, you still haven't fixed this? It's going to show up next year in next year's Acfr?
No, because the Acfr audit does that itself. And with respect to cracking the whip, I don't have a whip to crack. All I do is deliver information to the agencies as well as the council. I don't have a whip I can crack.
But you would like to see these prior year recommendations go away.
Absolutely. Anytime you can remediate something, that means you're preventing a problem from occurring.
Mr. City Administrator, you didn't think I was going to leave you off the hook, did you? So you're the one who actually has to kind of make sure these things happen. It was a little unfair for me to suggest Mr. Lucas has to do it. So why are these four still showing up?
The two Octo ones that we've spoken, I think, about most robustly here each have a unique root cause. The one on manage, develop, and implement a tracking solution related to system vulnerabilities. There is a capital project that's multi-year, that's ongoing, that is meant to address the identified management challenge here. At Octo, we have a robust response to incidents and a preventive program, but this ties back to a 3 to 4 year capital project that once complete, we believe will resolve this item. The other one dating back to 2018, which says implement a risk management framework to comply with NIST standards. NIST standards do change on a sometimes year to year or biannual basis. So Octo is always having to adjust to different NIST standards based on the expectation they have. I will use these questions that highlight one change that I think would profoundly improve security within the city, is that there ought to be in statute a common framework and minimum standard by which agencies, including independent agencies, must be held to maintain a basic cybersecurity presence, a risk profile, and notification of responses. And Octo is on the hook here, but there's a number of independent agencies that also should be applying themselves to the same standards that are articulated here.
And how do we get that standard?
I think it would have to be in statute. I don't think independent agencies, if any, they're not compelled to notify Octo of new software, not compelled to notify Octo of system changes or incidents in as timely a manner as agencies that report to the mayor are. It doesn't mean that we're perfect, but it's a known vulnerability that through statute, we might be able to improve.
So you could draft that legislation or have Octo draft that legislation and give it to us.
I'm happy to work with the council.
So with Octo, that's a capital budget. Is Octo the 2018 open recommendation or open issue? Is that the only capital one on the list?
Yes.
And has money actually been expended?
Yes, money has been spent. It was a 3-year project that has taken just a little bit longer to implement.
What's a little bit longer, like 5 years?
So we expect to be done this fiscal year, which would be 5.
Are you predicting that this will not show up on next year's Acfr?
I am stating that the agency believes that they will finish this in 2025, and therefore it should not show up if it's finished.
Anything else you can belabor? Why you spend? Anything else on this? What? I was about to give up, but apparently I'm wrong. Mr. IG, are there any additional Acfr related deliverables?
No. Highway Trust Fund. Okay, yeah, there's one more for Highway Trust Fund audit. Still has to be published, but other than that, they've all been published.
Which trust fund?
Highway Trust Fund.
Highway Trust Fund. Everything else is.
Yes, it's published on our website, and they've also been distributed.
When do you expect Highway Trust Fund?
That's 31. March 31 is when it's due.
That's a federal timetable, which is why you heard me complain about getting quarterly reports.
Yeah, that's a federal requirement. Right?
Yeah, the forecast is the last bit of our Acfr contract, and in years past, it's gone maybe April or as late as May. This year, we're moving it up to March 31st because our contract ends March 31st. So we're trying to get it done sooner.
Okay. Is that it? Thank you. Yes, were you about to say more?
I was going to say it's not late. So
Depends on who you're talking to. All right, that's going to conclude this hearing then. I want to thank you, each of you, for your testimony and your time. I think I'll leave it there. The record, if any member of the public or any of you want to submit anything else for the record closes on February 20th of this year, of this month. The time is 5:01 PM and this hearing is adjourned.